Estate Planning and Estate Taxes 101. So I'm going to be speaking for about 45 minutes, maybe 50 minutes, going to leave time for questions. We'll get through all the slides. The purpose of this is to give you a background on estate planning and estate taxes. And as you can imagine, this area of the law changes so often. So it's interesting, Lori and I were just speaking that I had to make some last minute changes because some last minute changes in the law. Here's my contact information. Again, I'm an elder law and estate planning attorney based in New York City and Long Island. So as far as my agenda, number one, I want to talk about assembling your estate planning team. And it's so wonderful working with Anthea about this. And she is such an integral part, or at least the financial advisor, such an integral part. The attorney does one thing, the advisor does another, and the two just simply go together and meshes well together. Want to define what estate planning is? Might surprise you a little bit. It is not just estate taxes, although it is estate taxes as well. What can estate planning do for you? That's a big question. Then we're going to take a fairly deep dive into taxable estates and assets and how that works. The power of portability, which is huge at this point. I'm going to explain all of that soon. Coordinating your estate plan and retirement planning is the key to many a successful estate plan. So, number one, assembling your team. It's the attorney, someone such as myself, a good attorney that basically concentrates his or her practice in estate planning. And elder law, planning for long-term care, has to be a part of that. I just worked yesterday with a client who was privately paying for a nursing home. Let's see, it was about $21,000 and change a month privately. So you have to think about that because a long-term illness could actually totally wreck your estate plan. But we will talk about estate planning, document preparation. That's what the team is involved as the attorney anyway. Elder care planning, because you have to include that. You have to think about the what ifs. And you also want to plan for potential incapacity. Even if you're running the marathon right now, you got to think about it and make sure that you plan. You hope it never happens, but be prepared. Then we have the financial advisor. You're going to be hearing from Anthea. And how crucial is this? Wealth management. Well, will the assets that are managed in your name be managed differently than if it's in a trust? Well, many times it is. And you want to go over investments, and your assets will be managed differently depending on your age and your need for income, or maybe the lack of need for income. But everyone's situation is different, and the financial advisor is at the core, along with the attorney, with regard to estate planning. And very importantly, the advisor talks about projecting what your expenses might be, your living expenses, and has to definitely think about the long-term care component. And there are ways to cover that as well. I spoke about Medicaid planning is a very good way to cover long-term care. And you're going to hear in a couple of weeks about how long-term care insurance is another way to protect your assets with regard to long-term care. And the accountant is very important. But I think I look at this as a three-legged stool. In order to keep that stool, upright and not collapsing, you do need the attorney, the financial advisor, and the accountant, all very important components to the estate plan and the estate planning team. So what is estate planning? Well, It refers to the management of how your assets can be transferred to beneficiaries when you pass away, with an eye on all of these issues that I just mentioned: potential gift taxes, estate taxes, and there are also capital gains tax issues for your beneficiaries. We're going to talk about that and many more things. One very good way to utilize living trust is to look at that estate plan. The living trust is actually a great vehicle to reduce an individual's or eliminate an individual's taxable estate, to get the basis step up, which I'll explain soon, so that your beneficiaries don't have a capital gains tax issue, and many, many more. And we also do income tax planning within a living trust as well. So again, one of the goals is to reduce the estate tax. There's a federal estate tax, there's a New York estate tax, and as you know, there are capital gains taxes also. Now, I do want to emphasize, the exclusion for federal estate taxes, in other words, the freebie, is a huge number. Right now, it's almost $13 million. And I would venture to say that very few of you listening here that have more than $13 million. But we are going to talk about estate taxes for a couple of reasons. Number one, in a couple of years, that number is going to be halved. And that was part of President Trump's initial bill. So right off the bat, we're dealing with half, number one. But even if your estate is smaller, estate planning is not just about estate and gift taxes. You want to make sure you have a good plan for your retirement, that your money will not, you'll have enough income and assets during your lifetime, and you want your money to outlive your retirement so that you can enjoy your life all the way through. That's part of your estate plan. You want to have a great succession plan for your business. You want to, if you do have a spouse or children, grandchildren, or any important beneficiary, you want to make sure that they're taken care of if that's something that's important to you. Maybe you have a disabled child. That's part of an estate plan. Planning for long-term care is part of it. Many times we get calls about a pet. How am I going to take care of my pet? I'm alone, and my pet is like my son or daughter, and I hear this all the time. We can take care of them. And I just saw an article, I forgot who it was, but it was in the news within the last week, where there was more than $1 million put in a trust for the pet of a famous actor or actress. I forgot who the name was. I'm not sure if you remember, Lori, or if you saw that, but that was very interesting. And you can do it. And you could help a child who may not be great with money, that you're concerned with. You might be concerned about a child. And very importantly, you want to make sure that your estate goes to the people you want it to go through. And we're going to talk about priorities of beneficiaries. So let's talk about a taxable estate. So what is part of your taxable estate? What does Uncle Sam and New York State want to tax over and above the exclusion levels? So what do they look at? The short answer is virtually everything. And I'm not exaggerating. So they look at almost everything. They look at your bank accounts. Most people say, well, okay, I get it. They look at your brokerage accounts, your stocks, your bonds. A lot of people don't realize that they look at your annuities. And not only will your annuity or annuities be part of your taxable estate, but if you had a tax-deferred annuity, you may have to pay income taxes and estate taxes on the annuity. So all of these things to think about. A lot of people don't think about that. And many people don't realize that your retirement accounts are also part of your taxable estate. And also, don't forget, unless they're Roth IRAs, you've deferred taxes on all of this money. So your beneficiaries, as they take money out, of these deferred accounts after your death, hopefully many years from now, but they're going to have to pay income taxes on that as well. And we're going to talk about stretching that out as much as possible in light of the new law, the Secure Act #1, and we just got Secure Act 2.0. Also, many people don't realize that, you might have expensive artwork. That's part of your taxable estate. Collectibles, part of your taxable estate. I have a friend who loves the Beatles, and still loves the Beatles. And he has so many collectibles and originals, paintings that John Lennon did. And, it's very, very valuable. And this is something he just cherishes. Well, that is subject to an estate tax later on. Jewelry as well. Most people don't realize, but that is also. Of course, your real estate, your investment property, your home, co-op, condo, that as well. And the last category that I'm going to cover here is life insurance. Most people don't realize that life insurance that you own is part of your taxable estate. And they even say, even if you transfer that, within 3 years of death, they call that a transfer that is made before you die, causa mortem, and they're going to include that in your taxable estate. So let's say you transfer the ownership of that life insurance policy, even a term policy with no cash value, part of your taxable estate. Let's say you transfer that 2 years before you passed away. You did that planning, and we set up this life insurance trust. If you didn't do it more than 3 years before you died, even that is part of your taxable estate. So a young individual that might have $6 million of life insurance for their child or her child or his child, you already have a taxable estate, at least for New York State, that you have to really think about, even if there's zero cash value. So it's something to think about because, again, what comprises your taxable estate? Virtually everything. So let's go over the federal and New York State unified credit or estate tax exemptions. So the gift and estate tax exemption that just changed a couple of weeks ago in January of 2023 rose tremendously. It's now almost $13 million per individual. A husband and wife together have almost $26 million. But look at that second bullet point. It is scheduled in the law to be halved as of January 1, 2026. So if you're a single individual, it'll be about 6.5 million, maybe a little bit more with inflation, and a husband and wife at around this level now, around 13 million. So if you're an individual and you don't have a spouse, that will be your level. Now, many people confuse the annual gift tax exclusion. It's currently, and just went up January 1, to $17,000 per individual. Married couple can give away $34,000. Let me explain what that means. Means that if you wanted to give to an individual $17,000 per calendar year, you could do that without filing a gift tax return. That's a Form 709. If you're married, you could give double that. That's called a split gift with a spouse. That's $34,000 per individual. So if I wanted to give $17,000 to each one of you listening today, I could write, no, I'm not going to do it, but I can, as an example, write out a check to 17,000 to each one of you, and I'm still going to have my 12.92 federal estate tax exemption still available to me. But let's say I gave one of you $117,000. First $17,000 per calendar year is an exclusion, the annual gift tax exclusion. So that could be disregarded, and I don't even have to file a return for that. But the remaining 100,000 is something that will reduce, and I'm simplifying it, reduce the 12.92 million to 12.82 million. And for most of you, might say, well, who cares? And I really wanted to clarify this because I see so many clients where we do a Medicaid planning, let's say, and they might say, well, I have $1 million in assets and I'm worried about gift taxes. And I said, don't be worried about it. You have almost 13 million ability to gift federally. And let's move to New York State on the right side of the screen. New York State's estate tax exclusion is about 6.5 million, 6.58 million. There is here, just like with life insurance, a 3-year rule. New York State says that if you have given away assets within 3 years of death, we're going to claw that back into your taxable estate and tax it at the time of death. So be aware of that. And whereas the federal, you're only taxed on your assets above the exclusion, New York State, if you go over that 6.58 million just a little bit, you've gone over the New York State estate tax cliff, and you're going to have to pay estate taxes from $1. So the planning that we do also involves ways to minimize or totally eliminate that estate tax cliff. And there are many, many ways to do it. But the New York State tax level isn't 40% like federal. It ranges from around 3% to 16%. But someone with a large estate, look at this, just add up the two percentages. For some individuals, it's over 50%. So let's talk about portability. So let's talk about what portability is. And I want to make sure that you understand for federal estate tax purposes, there is portability. But most people don't realize there's no portability for New York State. So we have to do special planning for this as well. So let me explain what portability is in very simple terms. Let's say there's a husband and wife, and they have a decent size estate. And let's say the husband dies, the wife has her own exemption now, 12.92 million, going to be about 6.5 million in a couple of years. So she has that. But when that spouse dies, the surviving spouse can actually claim the unused tax exemption. So if there's, let's say, $12 million left, the surviving spouse can claim that. But it doesn't happen automatically. We have to file a federal estate tax form and apply for portability. The IRS gave us a little more time to do this, up to 5 years, but a lot of people are starting to forget about it. So my advice is, you never know what might happen. You might win the lottery. That happened 2 times to a client of mine. Or maybe your business might boom, or maybe you will get an inheritance. But when a spouse dies, if you have a spouse that dies who hasn't used up his or her estate tax exemption, the balance of that exemption can be transferred over to you. And that's called portability of that exemption. And again, it does not happen automatically. The attorney has to proactively do something and file that estate tax return, that Form 706, to get the portability. What about New York State? Not so in New York State, there is no portability. So we have to dance around that and do special planning. So when the spouse dies in New York State with, let's say, $6.58 million of an estate tax exclusion, let's say he doesn't use it at all, well, at the time of death, if it's not used at all, it vanishes. Unlike federal, which could be transferred over, and that's what the portability is called. And we can do planning around that. And that's part of estate planning. So we want to coordinate the federal estate plan. And this is all holistic. So I'm talking from the attorney's point of view, but also from the financial advisor's point of view. So we need to work together on all of this. Because again, I said it a few times, we set up the trust and the trust has to be managed a certain way, but the financial advisor has to know exactly what's going on to make sure that distributions or income are given out and distributed exactly in accordance with what the trust says. And if it's not, it could make that trust invalid even. So the coordination between the attorney, I'm looking at it from the attorney's point of view, because that's what I do, but it has to be coordinated with the financial advisor. And that's why I'm so grateful, because we have Anthea and she's going over, that portion of this, which is extremely important. But right now I'm going to talk a little bit about how a will is part of this estate plan, as well as the power of attorney and a trust. Okay, why do you need a will? Well, a will sets forth where assets go when you pass away. Assets in a trust that is funded, those assets will pass, not with the will, with what the trust says. And if you have a beneficiary designation on a brokerage account or a bank account, that takes precedence over the will. So there has to be coordination. If you do a will and says, I give all my assets to child A, but you have a bank account with a beneficiary that says all the assets in that account go to child B, well, no matter what you say in your will, everything will go to child B. Or if you have your assets in a trust that says everything goes to child C, that would take precedence. So the attorney and the financial advisor has to go over your beneficiary designations on all the accounts to make sure your assets will go where you want them to go when you pass away. So in a will, we have the individual who creates the will, the last will and testament. That individual is called a testator. You have an executor, or female is called an executrix, who manages the assets after the will is probated. And then you have the beneficiaries. Now, beneficiaries in that will could obviously be an individual. It could be family members. It could be friends. It could be a charity. It doesn't have to be an individual. It could be a trust. A trust in a will is called a testamentary trust. I had mentioned it could be in a trust for a pet. It could be in a trust for your grandchildren. So all of this is coordinated. And many times people ask me, well, I love my son and I want him to be the executor, but he's a beneficiary. Is that possible? Absolutely. And I just bring it out because I hear that question so often. And next, I want to talk about a right of election. I want you to think about this. You could give your assets to anyone you want in your will or your trust. But there is a law in New York State that's called the right of election of a surviving spouse. And it says that if you do not provide for your surviving spouse the greater of 50,000 or 1/3 of your estate, the greater of 50,000 or higher, 1/3 of your estate, then that spouse can actually file for and get 1/3 of your estate. It's more complicated than that if the spouse is abandoned. And, there's so many different criteria for this. And there's a short statute of limitation, which is actually 6 months to elect this after the nomination of the executor. But in certain circumstances, it goes up to 2 years. And in a small number of circumstances could be even longer, but usually not. But think about it. If you don't want your assets to go to your spouse for whatever reason, make sure that you have a prenup or even after marriage, a post-nuptial agreement. And the law says if you want to reduce your estate and make some gifts so you don't have as much in your estate because you don't want that spouse to elect on your entire estate, the law says gifts made within 1 year of death come back, and that spouse can elect for that 1/3 or 50,000 on those monies. So you want to plan in advance. So your will complements your trust. Number one, many times we have a pour-over will that says if there's some assets that are not transferred into the trust, the will take over. It could be at a minimum a catch-all, which is great. And we call that pour-over trust. We also have, that's a lifetime trust. We also have a testamentary trust in the will. And sometimes the law provides that we need to use a trust in a will and not a lifetime trust and not a living trust. So depending on the circumstance, and one circumstance is if a spouse is on Medicaid and one spouse wants to provide for that other spouse, New York State law doesn't let us do that in a living trust, only with a trust in a will, a testamentary trust. A will is great, but it doesn't avoid probate. It doesn't avoid Medicaid recovery, etc. So living trusts are usually a better way of doing things, but not in all circumstances. What about a power of attorney? How can a power of attorney fit into an estate plan? And boy, does it. So you need to have a power of attorney for estate planning, for Medicaid planning. We have to add in all of these extra provisions, not something that should be done on your own, because you want to give the agent, you don't know what's going to happen to the law in the future. Maybe they'll do away with estate taxes. And by the way, there's a proposal right now where there's someone proposing, I believe in Congress, not the Senate, to eliminate estate taxes. I don't think it's going to go anywhere, but it's out there. Maybe that'll happen. We're going to need to modify our trusts. Maybe you're incapacitated, God forbid, but incapacitated, who's going to do that? And the form power of attorney won't let you do the estate planning after incapacity unless you have a good power of attorney with provisions that specifically give the right to the agent on the power to modify or revoke a trust, or to exercise the power of appointment. What does that mean? It basically says, for example, let's say there's a beneficiary that's supposed to get outright. You want to give child A half of your estate, but after you become incapacitated and you can't change your documents, then that child becomes incapacitated. God forbid. And you want that child to be on Medicaid and SSI, but you want to give them a war chance. Well, the agent on the power of attorney can actually exercise this power of appointment and change that beneficiary to a supplemental needs trust for that child, not having the assets go outright, and make so many other elections for estate tax purposes, gift tax purposes, disclaim an inheritance, even make annual exclusion gifts to children, take certain tax elections, so important, and the list goes on and on. So a good power of attorney is an integral part of estate planning. And what about trusts? You all know that trust is an entity that is created typically by the estate planning attorney, that it's an entity that holds assets, and the assets are managed by a trustee of the trust in accordance with the terms of the trust, and then distributed later on. So they're distributed in a certain way during the lifetime of the creator of the trust. And upon death, they're distributed just like a will, could be outright, could be in a trust. The assets could go to a charity, could go to a continuing trust, etc. And every trust is drafted differently. But what's the difference between a will and a trust? Well, in order for a will to be valid, it has to go through probate. But living trusts, not testamentary trusts, because that's a trust within the will, living trusts avoid probate for the assets in the trust. There are no privacy issues, because when you probate a will, that's a matter of public record. How crazy have we seen so many wills of famous people because they didn't do proper planning? I mean, if you go online and Google John Lennon's will, because I just spoke about John Lennon before, and I'm a fan too. I thought he was amazing. But, we get to see his will. How crazy is that? But don't let that happen to you. And a living trust can definitely prevent that. It also expedites the distribution of assets. You don't have to go through the whole probate process. It helps to avoid a will contest in case you think there might be some issues. And very importantly, when you have a trust, and let's say all the assets are in the trust, and let's say let's say you're the trustee of the trust, which is fine, and then you become incapacitated. There's continuity of management. You don't even have to show the power of attorney or anything like that, because the successor agent simply takes over. So we have continuity of management of assets in the event of incapacity, and that is a very seamless process. So I want to talk about a grantor trust and grantor trust status. A grantor trust is a trust in which the creator of the trust, who's called the grantor, continues to be treated as the owner of the trust for income tax purposes, even though the income might go to a third party. Let me say that again. So if we create a trust and we could say it's a grantor trust, then the assets in that trust for income tax purposes is considered the creator of the trust. So in order to reduce estate taxes, we can have a client transfer assets into a completed gift trust. It's out of the individual's name for gift tax and estate tax purposes. How great is that? And let's say all of the income are going to the children. But with the grantor trust status, the grantor, the creator of the trust, could continue or must continue to pay the income taxes on those assets that were already gifted And what does that do for wealthier clients? Further reduces the taxable estate. So just keep in mind, there's a way to even reduce gift and estate taxes if we create a trust that is called a grantor trust. Okay. What about Medicaid planning? Well, as I told you just yesterday, we had a client that was privately paying over $21,000 in a nursing home in Queens. Not that far away, right? So incredible. I was shocked. I thought it was a little bit less than that, under 20,000, but that's what it was. So if we don't talk about Medicaid planning, not being prepared for long-term care, and I already gave a talk on Medicaid planning, and Anthea is going to be talking, in February on long-term care insurance, both very good ways to be prepared for long-term care, but it's got to be part of the estate plan. We had a client that lost $1 million for long-term care. If you don't include it in your estate plan, that's just being very short-sighted. So if we do a Medicaid trust, and I did speak about this already, so I'm only going to speak for another minute, but if assets are in this Medicaid trust, we can also use that Medicaid trust to save on estate taxes. So it could be an estate tax trust where there's estate tax protection, and a Medicaid trust, same trust, for Medicaid protection, and it can avoid probate and make sure assets go to your beneficiaries and avoid Medicaid recovery all at the same time. So if that's something that might fit your situation, that certainly is part of the estate plan. And again, the last bullet point, and things have changed so much just in the last few days. It's unbelievable. But with regard to Medicaid, it used to be during COVID, the public health emergency, you could just say to Medicaid, I have X number of dollars in the bank, and these are my assets, this is my income, and Medicaid would be required to accept that. And it's called just stating your assets for Medicaid purposes. And Medicaid has to provide the care and could not take anyone off the rolls, even if they had more money and they were eligible. But that era is changing. And the elder law attorney has to step in many of these cases where the elder law attorney wasn't needed before with regard to doing the Medicaid Act, because things are different now. And this just changed. So Medicaid is starting to do a full review, going to start very shortly, a full review of assets and income to determine eligibility for new applicants. And when the renewal is up, they are going to review the assets and income for those on Medicaid, and those that have unfortunately lied who are on Medicaid will be thrown off the rolls, but they're going to be doing a comprehensive review. So we just found this out. So what are the benefits of a trust? Very simply, and just going over this, because I did go over most of this before in the last session, you can get, instead of a carryover basis at the time of death, a basis step up. So instead of giving the home to a child now for planning purposes, we put it into a trust, and that home is out for Medicaid, but there won't be any capital gains tax issues for the beneficiaries, likely the children. That's gone. So there's no capital gains, zero upon death. And if you want to sell that home during lifetime, you actually retain the full $250,000 capital gains tax exclusion. Not if the home is not in a trust, and if it's just given to the child or your beneficiaries, only if it's in a special trust. If you have assets that the individual keeps holding, there are creditor issues. Assets in a trust, you have the asset protection. Creditor issues are not an issue. If assets are given to a child and the child dies, that could be a big issue. If the spouse acts up, or the child becomes incapacitated, or let's say they get divorced and there's equitable distribution, your assets might go to someone you certainly don't want your assets to go to. So when you're doing this type of planning, better to have a will, but that's a pour of a will into a trust that's already created. And you want to make sure that your inheritance, I should say your inheritance, your children's inheritances, or whoever your beneficiaries are, it could be a brother, a sister, a friend, anyone, a pet, anyone you want. You want to make sure that the inheritance is not squandered. And we see that time in and time out. Again, if there's a minor, make sure they don't get it too soon. Because if you think they could squander those assets, make sure they get your assets at age 30 or 35 or 25, whatever you think is right. You want to make sure that the current minors don't get the assets until they're going to be financially stable. So a minor's trust, whether that's going to be in a will or in a living trust, is extremely important. And you want to make sure those assets in a minor's trust are managed differently by the financial advisor than if they were given outright. So, again, we do the trust, etc. But someone like Anthea will come in, or any financial advisor of your choice, and that's very important part of the plan. If you have a special needs beneficiary, you want to make sure that assets don't go directly to that beneficiary, and then they can't qualify for Medicaid or SSI. So there's a way to do it. Let's say it's 500,000, 800,000, 100,000. It could go into a special needs or supplemental needs trust so that the individual can always stay on Medicaid, always stay on SSI, and get those services. But if they have supplemental needs or special needs, such as, it's a disabled child and they want to go to a special camp during the summertime, or special programs that Medicaid and SSI, that's not part of the deal. There's a war chest for that. And it's a way to preserve assets. And when you do that, and that's part of your will or trust, that's called a third-party trust. And Medicaid will not recover against those assets. So the special needs trust, Medicaid won't recover against it. And at the time of death of the disabled individual, the assets could go to other family members. It could be other children, etc. So it's a win-win situation. And spendthrift trusts. Well, if you have an individual that cannot control their spending, trust is perfect. It's a trust. We can set up a trust whereby the assets and income that are distributed to that individual, it could be a child, it could be anybody, assets distributed to that individual are doled out in a certain way that you predetermine. And that's called a spendthrift trust. And we could do it any which way you want. A conversation about estate planning and estate taxes has to include the irrevocable life insurance trust. Let me give you an example. Let's say you're a single parent and you took out, might be similar to an example I gave before, you took out a $6 million life insurance policy for the benefit of a child. Number one, if it's a minor, I want to make sure that the proceeds don't go out to that child right away. But You remember I said before, if you own that life insurance policy, even if it's a term policy, that is going to be part of your taxable estate. And even if you transferred it out before death, if it happened between 3 years of death, it's still part of your taxable estate. So you want to be proactive and do your estate planning, well within 3 years before you pass away. And we're not God, we don't know when that is. So what does that mean? Do your estate planning now, God willing, while you're well and healthy and vibrant and know what you want to do. But we could take that term policy that you own, transfer it into an ILIT, an irrevocable life insurance trust, and it's out of your estate. And we don't even use, in my example, any part of your exclusion. We saved $6 million of your taxable estate, which could easily be, for wealthier individuals, $3 million. Crazy. So you got to do your planning. Retirement planning is also quite important. I am going to be finished in just a couple of minutes, but we did have Secure Act number 1, which actually raised the level where you have to start taking out your required beginning date. You have to start to take assets out of your estate. Secure Act number 1 raised it to 72, and now with Secure Act number 2, they raised it just this year to age 73. And with the Secure Act, there's a 10-year rule. The rule used to be before, and still is, for spouses. Spouses could just, the spouse is the beneficiary of a retirement account, they could simply roll over their IRAs into their own and take over their life expectancies. But for other individuals now, there's a 10-year rule. The IRS wants that money to come out quicker so they could tax it. So there's a 10-year rule where now those assets, except for a spouse, have to come out within a 10-year period unless the beneficiary is a surviving spouse, a disabled individual, chronically ill individual, or a minor. And if it's a minor, that 10-year period starts at the age of majority. So if that minor is, let's say, 8, well, there's 10 years to age 18, the age of majority in New York State, and then they tack on another 10 years. Stretch IRA is where we're stretching those distributions. So there is some, you're taking those required distributions, but the rest of your assets are growing tax deferred. And in the middle bullet point, we don't have much time, but you could read that later on. It shows the magic of deferrals and how much money can grow if it's deferred. And that really does make a difference. Now, there's a Secure Act 2.0, which was just passed in 2022, just became effective a couple of weeks ago. It changed the required beginning date. We have to take your required minimum distributions from age 72 to age 73. And starting in 2032, many years from now, goes up to age 75. They also added an extra $1,000 for individuals age 50 to make contributions to IRA. The catch-ups for individuals also over 50 have been increased. And the IRS just told us, before we thought that, if there's a 10-year rule, you only have to make distributions within that 10-year period, and you could keep those assets and have them deferred, the distributions until right before the 10 years. The IRS just said, no, we're not going to do that. Just to make it more difficult for us, they want distributions in years 1 to 9 as well. So things become more and more complicated. I'm an attorney, and I guess we all have disclaimers. So that's a disclaimer. And we don't want you to forget about class number 6. So I wanted to leave time for some questions if there are any, and I'm more than happy to answer them.
Yeah, we do have some, Ron.
Okay, sure. My pleasure.
Is a Medicaid asset trust appropriate for people at all levels of net worth?
No, it's not appropriate for all levels of net worth. I mean, if somebody comes into my office with $10 million, 15, $20 million, we'll do estate planning for them. But look, the system wasn't meant for that. But the system was meant for an individual that's in the lower middle class, for poorer individuals with less resources. But people don't realize it started off for individuals in the middle class. And that's where the elder law attorneys, such as myself, come in, where we have to do proactive planning. So if someone has $1 million plus a co-op and some money in a retirement account, yeah, they're definitely someone that we should do planning for. When the nursing home is 21,000 a month, if we don't do this planning, the individual could go broke or the spouse could go broke, and we certainly don't want that.
Okay, does a pour over will avoid probate? If not, why have one? Why not just have a trust?
The pour over will does not avoid probate. And we try to avoid probate with a trust and beneficiary designations. But what if there's something that was not included in your trust or your beneficiary designation, or that collectible, or the individual that has the John Lennon paintings, which are worth quite a bit of money now, etc., or the diamond engagement ring that you have? What's going to happen to that? Well, if there's no beneficiary designation, it's not in a trust, we want a vehicle that will make sure no matter what you have, and no matter where it is, if you forgot about it or you didn't think about it, it's going to go to your intended beneficiaries.
Okay. We've got Ron here for another 7 minutes. So if anyone has any questions that they want to ask specifically, he is here to answer them, and that's a fabulous opportunity. And if there are no more questions, is there another topic that you wanted to spend a little bit more time on, Ron?
Well, I'm happy to, if you know what, even if there's no questions, if somebody wants me to talk about a topic that I know about, I'm an estate planning and elder law attorney, I'm more than happy to talk about that. If anybody would like me to touch on something or clarify something that I already did,
we have a question. We have a question. Okay.
Sounds good.
Without a will, oh, we have, now they're coming in. Without a will or trust, how will a parent's co-op that she's living in pass on to her 2 children after she passes? The spouse has already passed. She has no other assets.
If there's no will and no trust and no beneficiary designation, which you're not going to have on a co-op, let's say, assets in New York State go to individuals that are part of a priority. It's in the Estates, Powers, and Trust Law, Article 4, and it basically says that if there are no children but a spouse, the co-op or any other assets will go to the spouse. If there are children but no spouse, all of it goes to the children. If there is a spouse and a child or children, then the first 50,000 goes to the spouse, and then it's split between the spouse and children. If there is no spouse and no children, it goes to parents, and it goes to brothers and sisters, and it goes on and on. But if there's no, at a certain point it ends. And if there's no family, then it could go to the state. But many people think, oh, it just goes to New York State. It does.
Now
but
they're
not,
really, go ahead.
Not before it goes through this, all these people.
If you pay a large bill for a relative, is that subject to a gift tax?
Yes. Well, wait. Don't forget, you pay a large bill. You have a $17,000 annual exclusion. It's got to be over 17,000. And then, let's say your bill is 100,000. You have $12.92 million of a federal exclusion. So you don't pay the tax, you just reduce your exclusion a little bit. And New York State does not have an estate tax. I'm sorry, does not have a gift tax, but it has the estate tax. So we look to the federal, and you have this huge exclusion that you now know will be had at the end of 2025, starting in 2026.
Okay. Who pays the taxes on money that you give to a family member? If I give my son $10,000, who pays the taxes on it?
Again, you get 12,000, you have $17,000 of an annual exclusion amount, no gift tax. And then you have another $12.92 million to gift, because that's the freebie.
What if a
But
person does not?
if there's going to be an estate tax, it's the giver of the gift. Sounds crazy, but is taxed on the ability to make gifts. But they give you this huge exclusion, and you're not going to pay a tax until you get up to those huge numbers.
Okay, what if a person does not have any estate planning, and does the asset become a ward of the state?
No. I mean, you want a will, so you dictate where your assets go, and you want a living trust for all the reasons I went through. But if you don't do anything, no, it goes through the protocol that I just mentioned. If there's a spouse, children, and all of that, which I just went through, that's where it would go. If you don't have any beneficiary designations, no will, and no trust.
Okay, as a recipient of a beneficiary IRA that more than 10 years ago, what are the required annual distributions?
I believe that they're just going to stay the way they are for you.
Which was?
Over the beneficiary's life expectancy.
Okay. And for people who have assets in the Caribbean, etc., can that property or money be traced and factored in anything?
I want to talk about tracing, because maybe they won't find it, but it doesn't mean it's tax evasion, which is a felony. So I don't think I'm going to talk about tracing, but it could be a part of your taxable estate, and the attorney would really need to know about that.
Okay. Can you once again, Ron, give us your contact info so that I could type it into the chat box, because someone wants it.
Thank you so much.
Well, actually, there is a slide that has it. Yeah, there we go.
There we go.
So anyone who wants to reach out to Ron, that's where you can find him.